Silicon Valley is all in on the AI revolution, and so is Wall Street. It's leading some to warn about an AI bubble. So how worried should you be? What is an asset bubble anyway? And what happens to the real economy when one pops? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Will the AI bet pay off? That's the question everyone's asking, in quarterly earning calls and at the IMF meetings in DC. And it's hanging over the broader economy. An economy that has so far proved resilient as it navigates trade risks and geopolitical uncertainty. But what about the risk of a potential AI bubble? It's something investors and policymakers are trying to figure out. This week's podcast is all about bubbles and how they affect the real world. To find out more, I spoke to Mike Dolan, Reuters editor-at-large for finance and markets. Morning, Mike.
Good morning, Carmel. How are you?
I'm good. We're talking bubbles today. Are you feeling effervescent?
Not after Friday. It was less than bubblicious, I have to say.
Indeed.
But maybe that sort of move is exactly the reflection of what some people fear, is that we're in frothy territory.
Well, it's interesting, isn't it? Like market bubbles, they sort of follow a pattern, don't they? They have a sort of an ebb and flow to them. There's the kind of the innovation stage, there's the boom stage, the euphoria. Mm-hmm. Then there's the savvy investor getting in, selling, and then there's the panic, right?
Mm-hmm.
How do you define market bubbles?
Look, it's a neat way that you've just described the stages of bubble blowing.
Right.
But it's usually impossible to tell whether you're in a bubble in the first place, because in effect, it's a little bit easier, I think, in physical markets like commodities and so on. So there's a finite supply, and then you get a wave of overexcited demand that shoves prices way beyond what you can see, and that's the supply and demand equation. It's much different, I think, when you're dealing in financial stocks and in companies that could well be the future, because ultimately what people are betting on is what the value of that stock or that sector or that idea, even some cases, will be in years hence. And where we are at the moment, of course, is very much like that. People do think there's a quantum leap in artificial intelligence and all that goes with it, and a need to rethink where the entire economy, not just that sector, might be by the end of this decade or even sooner. Mm-hmm. So the idea, I guess, of easily being able to identify a bubble is wrong. It really depends on your time horizon in many effects, right? So if you think that a company is even not making any money now, which was the case in probably the most famous bubble of our era, in the dot-com bubble in 99, 2000, many of those companies were trading at 100 plus times their earning, because many of them weren't even earning very much. There were some of them were even loss making at that point. So when you look back at an era like that, you think, okay, that should have been obvious to everyone. However, as many people point out, if you'd picked the leading lights of even that gigantic bubble and held on to them for 5, 10, 15 years, if you were holding Amazon or Microsoft, even if you bought them at the peak of that bubble, you'd be very wealthy now. Mm-hmm. So there's so many different factors to get into. It's about really how far ahead you're willing to look as to whether the stocks in particular are going to be part of that transformed economy. And I think that's the essence of it. The inevitability, of course, in the meantime, is that you lose a lot of money on stuff that doesn't make it. And I think therein lies the danger.
Yeah. Then
you have another problem that comes around, that it's not only a question of time before it delivers, but maybe it doesn't deliver at all. Maybe it's not what people assume. So more questions than answers than that. But the idea that you can easily say, we're now in bubble territory, just is not the case.
It's not easy to identify the exact stages of a bubble at the right time, but as someone who's covered markets for a long time, is there like a particular metric that you lean on? Is like there's something that gets your spidey sense tingling?
Yeah, I mean, look, there's no one thing, but I suppose as many people would say in markets, there's always a kind of a feel about it.
Right.
And I know that sounds ludicrously non-specific, but you can go to try and get the metrics, which is basic valuations of stocks that are pricing things way beyond what their intrinsic value, as people would say, right?
Yeah.
And for that, you really just got to look at basic valuations. However, there's a behavior around it that I think is more of a touchy-feely thing than it is necessarily something you can measure. But I suppose more recently we would have called this FOMO, right? So it's the whole fear of missing out.
Yeah.
And that sort of behavior, and also this kind of idea that the narratives are endlessly positive. You see a lot of this in the crypto world. There is a feeling that the investment is based on just that price going higher, rather than any real analysis or change in the underlying story of what's happening with the technology or the idea or whatever it is that you're betting on. And, right now there's a lot of that. I mean, we've only had 2 years really of this generative AI boom, but already we've seen just unbelievable price moves, most obviously in the leading light of NVIDIA, which is the chip designer at the center of the whole piece. But it is that behavior thing, and it is in narrative, and it is in endless cheerleading where you do get really worried about it. And I suppose the famous phrase that crops up all the time, which is this time it's different. So when you see valuations stretched to the degree to which they are, for the acolytes, it's often this time it's different, that this is not like previous bubbles. There's something very dramatically new and fresh and something everyone else doesn't understand. So those sorts of phrases pop up.
Right.
One very interesting note that was done by Deutsche Bank recently, actually, was quite a clever way of looking at it, where they looked at the amount of searches for AI bubbles.
Right.
So it was, to what extent is AI bubble a bubble? Or at least the fear of it, a bubble.
Getting into quite a circular thing there. Yeah.
It starts feeding on itself. Much like all speculative frenzies, you really have to watch things that are related to it.
Yeah.
So it's really just a feel. It's a notion.
Okay, so thinking of one of the most notorious speculative frenzies of recent times, it's the topic of this week's quiz. Which dot-com company was one of the biggest flops of the early 2000s, having raised $375 million in its IPO and reaching a market cap of over $6 billion before going bankrupt less than a year later? Was it A, Boo.com, B, Webvan, or C, Pets.com? We'll have the answer for you at the end of the show. Up next, Silicon Valley's FOMO. So, Mike, the big question, of course, everyone wants answered is, are we in a bubble now? Right?
Mm-hmm.
Easy answer?
No, there's no easy answer. Sorry to disappoint. There is no easy answer. So the inevitable discussion about a bubble is interesting in and of itself, right? Because people will look at valuations. They will look at them being historically very high. That's not in doubt. We're running at, for the S&P as a whole, over 30, or for at least the leading lights of it, over 30 times forward earnings.
Yeah.
These are not quite historic or all-time highs, but they're up there, and we're still a little bit from where we're.
And not as high as the dot-com level either, right?
Yeah, we're still a little bit off that. Yeah, still a little bit off that. But that was nuts. I mean, you really have to look at some of those valuations at that time. We're talking individual stocks trading at 100 plus, 200 in some cases, times earnings, and many valuations on companies that weren't even making money at the time. So the whole piece, and it was stretched across the whole market, or a very large part of the tech market, the NASDAQ as its relative infancy back then. And so now it's concentrated in some very big stocks indeed. And when you strip out lots of those valuations from, say, the top 10, 20 leading stocks, it starts to look less frothy.
Right.
So the big question comes back as, are these companies capable of sustaining these valuations? And there is a reasonable argument, I think, from the tech people who are eulogizing AI, that, these are companies that have very big cash flow. They're investing that cash. It's not leveraged. in any great degree.
Mm.
And there was that famous, or now famous, quote from Mark Zuckerberg recently, which said that he was quite happy that they would be potentially misspending hundreds of billions of dollars because it's worse than not being involved in something as transformative as this.
Right, you want to have that first mover advantage.
Yeah, and I think you can understand that implicitly, but also that sort of behavior is also something that unnerves people because it's reflective of this idea of FOMO, this fear of missing out. And from a corporate level, that's a lot of money, hundreds of billions. They may have it, but it's a lot of cash to be burning if it doesn't work.
So the action in the gold market is interesting, right? What does that tell us about how people are feeling about this kind of AI revolution?
I think the gold move is fascinating as a reflector of what might be going on, because there's little doubt that within the stock market itself, there is a certain amount of chase it, FOMO, call it what you like.
Yeah.
But there's also an awareness. So it's not as if people are deaf and blind to all the bubble worries that might be around them.
Mm-hmm.
And so an aspect of this could well be that people are beginning to chase what could be another 2 or 3 years of exponential rises in any AI-related stocks, but also mindful of the fact that you want to hedge that. So adding some gold to their portfolio as a way of
hedging their bets.
Yeah, kind of keeping you. But they're both rising in tandem, and I think that is something that you really got to look at hard. There are potentially other reasons for this, that global inflation itself is running hot and policy geared towards a world where inflation just stays high, which is good for gold and good for stocks. Anyway, so you could make that prosaically.
So you've got concentration risk in that a lot of money is riding on just a handful of companies spending a lot of money to get this like AI revolution off the ground. But then more fundamentally for the global economy, is it going to deliver big productivity gains for the rest of the corporate world?
And that's the bigger question. So it's one thing building the infrastructure to be able to deliver some of the capabilities in this area, but does it actually make companies any money when they adopt it? Does it actually enhance returns on the rest of the corporate world once it adopts it? And I think that's the juncture at which we get a reality check on this whole story, because on one level, if they do adopt it and it does enhance returns, well, that proves the case.
Right.
It proves the investment, it justifies it. It will then, for everyone in the world, everyone who's going to be affected by this, whether it's in banking or whether that's in any other industry that you're going to be dealing with, AI is going to be part of what you experience, and it will transform the world in the way in which people imagine it might, or those who are its supporters imagine it might. If that doesn't happen, then what is the use case? Where is all that money gone?
Yeah, I mean, there's a number of issues, isn't it? There's A, is it going to live up to its potential? B, are they even going to be able to get all the energy that they need? All the how they're going to fund it? And then I suppose the kind of the unknowns, right? The risk that what we saw earlier this year with DeepSeek, that someone can come along and do it for far less money.
Yeah.
These are all potential shocks to the story, right?
Yeah, and that raises an interesting question about the risk, the individual corporate risk involved, and I suppose then by definition the investor risk is that you may believe in the technology, and so the DeepSeek example is a very good one that you raise. The Chinese claim this is almost just as good and it's done cheaper, and it certainly questions the sort of investment that's already being put into it in the States. But you have to separate then the degree to which that technology is therefore embedded, but the individual investments for the individual stocks may not be successful. And for that, we have to go back to the dot-com bubble as our great recent historical example. And it is that fact, isn't it? It's that the whole market was taken down by a fear of a bubble burst and the overvaluation, and it wasn't all going to hit. But ultimately, the internet, which essentially it was a bet on, is now the part of everyone's lives. It's integrally involved in pretty much everything that we care to think of.
Yeah.
And it is the sort of future that people were betting on back at that time. And the leading stocks that survived it and were successful in navigating it have performed and were worth the investment. But you might have lost an awful lot of money if you hadn't picked the right stocks. And that's the bit about closing your eyes and just buying anything that's related to it.
If you're enjoying listening to Mike, maybe you'd like to check out his columns as well. You can find them on Reuters ROI, a one-stop shop for analysis and commentary on the Reuters app and Reuters.com. Stay tuned to hear how the wealth effect from rising stock prices feeds into the real economy. Talk to me about the real world impact if this is a bubble and it bursts, right? Because we talked a lot about the stock market, but the excitement over AI, it feels like it's bled into almost every aspect of the economy, like equity, but also debt, energy markets. Yeah. What is the potential fallout here if this is a bubble and therefore it bursts?
The impact on the wider economy. So we talk a lot, we're focused a lot about on stock markets, right?
Yes.
But there are other bubbles in financial markets. And probably the biggest of them all, by some distance, certainly in our lifetimes, was actually a credit bubble. And the credit bubble that led up to the banking crash of 2007, 2008 was gigantic.
Mm-hmm.
And it was something that did very quickly take down the entire world economy. And we saw a world recession at the end of 2009, early 2010. It just unfold from the scale of the damage done to credit and lending around the world. But stocks are different because ultimately it's whoever's invested in them. If people lose money, it goes to zero. That's kind of tough luck in most people's eyes. So for the economic impact of the loss incurred for people buying into that, then it just depends on how widespread investment is. And then people look at kind of wealth effects of the stock market at large. So if this were a bubble, or if we're in that territory, then what's happening is it's dragging up the entire stock market, not just people who want to bet on those individual stocks. Although they are very popular stocks generally for lots of reasons. Anyone invested in the S&P 500, for example, is now going to necessarily have a massive exposure to this, because they're something like 34% of the entire market cap. Magnificent Seven, as they're known as, those mega caps who are leading the way, over a third of the entire market cap of the S&P 500. So if you're just simply putting your money away into an equity investment fund, you're going to suffer if this one goes down, right? Or if this reverses or there's a major correction. And from that, we talk about the wealth effect on the economy then. And people have done lots of interesting kind of number crunching on this over the last few years. Even last year when stocks were rocketing, I think people estimated that the wealth effect, which is essentially doesn't mean that people sell those stocks and then buy other things. It just means that people feel wealthier by virtue of the fact that their paper savings are so much higher. So when they look at their bank accounts or their savings accounts or their investment portfolios, and they see everything's up 20 or 30%, then they feel more emboldened to go out and buy cars and holidays and all the other things that fuel the economy. So if you reverse that, then you can work it out.
It affects consumer spending. Is that wealth effect, that feel-good factor, is it amplified now because of the rise of, trading platforms like Robinhood? You've got more retail investors involved. Like traditionally, wealthier people held a larger, stock of their wealth in stocks. But has that changed now? And therefore, is the potential impact greater on the economy because everyday ordinary people now have stock trading accounts?
Yeah, I mean, there's two ways of looking at it. I think direct exposure to stocks has risen. I think the last numbers I saw on this is now above 20% of Americans, at least, have direct exposure. And so people will be more aware of it and more sensitive to it, you would imagine, in that regard. I think there's also been a rise in the more and more people who get involved in the digital economy itself. Many of those companies pay, the compensation is in stock itself. So their wealth effect is related to the kind of annual compensation that they have.
Right.
So there are many directions. How does it affect the overall? I think the problem is largely to do with the skew of wealth generally. If you think about 10% of the highest 10% of earners in the US drives about 50% of the aggregate consumer spending. It's incredible. So,
wow.
And they are naturally most exposed to stocks because they hold most of them. So if you see a very big correction or even the slightest of retrenchment amongst people in that kind of cohort, then you will have a ripple effect across the economy. And then inevitably company investment suffers when you get a very big market downturn. So employment, hiring plans start to grind to a halt for a period. And we saw that very much after the dot-com. It wasn't a huge economic recession. There was a short and shallow technical recession, but there was a big business recession.
Yeah.
And that affected hiring and the economy for a number of years after that.
Yeah.
So there are numerous ways in which a bubble burst will filter through the economy, but probably the wealth effect is the most immediate. And people just look at their savings and investments and see them.
There is also the business side of those. Well, you mentioned that in relation to the .com, but even in relation to now with AI, we have seen that like spending on AI has helped drive US economic growth, spending on business equipment, spending on intellectual property, right? That is another big risk factor, right? Beyond people losing money on, on their nest eggs.
Yeah. I mean, that's very true. Yeah. And I think, you can see that while consumer spending has been, as it always is in the US, a very big part of the economy and therefore crucial to any expansion, that a lot of the GDP surprise, if you like, over the last year has continued to come in areas that you wouldn't have expected, sort of in that sort of business construction area and the physical aspect.
Yeah.
But I think that one of the things that people do worry about, or at least spend a lot of time kind of trying to assess, is the extent to which these big companies that are spending all this money are the digital giants that we're all familiar with. And these companies often had very little physical parts of their operations. They were quite essentially generating enormous amounts of income from intangibles, as we know them as, right?
Yeah.
And suddenly now they're being forced to invest in very real things, in bricks and mortar, in data centers, in energy and so on. And it does leave them also more focused on what happens in the real economy as well. So there's a reconnection of the digital world as well as everyone else being affected by it.
Yeah.
And how you value those stocks, I suppose, maybe is changing also.
Yeah.
And as you mentioned earlier on, perhaps once they've used their cash low or their free cash piles at the moment on this investment, then to what extent will they be borrowers in the future as well? So that is another aspect that can come back to affect the wider economy as a whole.
Speaking of the wider economy, did you know there's a newsletter to go along with this show? It's called Reuters Econ World and it lands every Thursday. We'll put a link to subscribe to it on the show description. You can also find it on the Reuters app. Just go to menu and scroll down for newsletters. In the final part of the show, we look at bubble's legacy effect. You mentioned in the wake of the .com, the .com bust, that there was a shallow recession. At that time, though, the Fed really stepped in, right? Dropped interest rates ultimately to 1%. The government cut taxes, raised spending. If the AI boom is a bubble that's going to burst, the US government isn't in a great position to help out, right?
Directly, you'd say no. The Fed's not in a terribly bad position to help out because obviously we've got interest rates much higher than they have been for much of the decade prior to the pandemic, for example. So they have dry powder, as people would say, to step in. And if you go back and look at that whole episode around the late 90s and how the Fed reacted or how policy reacted, it is an interesting comparison because one of the aspects about bubbles generally is that, of course, whether you're correct or incorrect in identifying one, you can't time it. It's impossible to time.
Yeah.
And if we remember, and I remember very well when former Fed Chair Alan Greenspan raised the red flag with his irrational exuberance speech back in, that was late 1996.
Mm-hmm.
And, the peak of that bubble did not kind of hit until March 2000. So we're talking about, 4 or 5 years. And even interestingly, after having raised concerns about overextended markets at that point, the Fed then went on to cut interest rates about 18 months later because fearful of other global crises coming back to hit America. So it actually ended up inflating those final throes of that bubble. So, but it did floor interest rates to respond to the kind of business-led recession, which in a sense held the whole economy up because what happened at the time was that it helped inflate the housing market.
Mm-hmm. Right, which led to another bubble.
And as we know,
a bubble begets a bubble.
That then 5 years later, we ended up back in a housing bubble that came unstuck in the credit crash.
Right.
So these things they mirror themselves. How policy reacts to them tends to explain how they pan out. But as regards government at large, I think the fiscal situation is very, very different than it was back then. If you remember, the US went into 2000 with a budget surplus.
Surplus, that's right. Yeah.
And they were retiring the long bond, et cetera, et cetera. That's certainly not the case at the moment. So probably would come down to a monetary rescue, at least at first order, if there was a need to.
Are they ever a good thing, bubbles?
That's a good question. Perhaps they're necessary. I mean, they're mostly related to transformative changes in technology. I think if you go back even beyond the periods in which we were looking back, you go back 100 years or even further, whether it's railroads or whether it's electricity or whatever else, you know.
We won't mention the tulips. We won't mention the tulips of Amsterdam. That wasn't... That helped no one.
It didn't. There wasn't a transformative technology related to tulips that I'm
no, they looked pretty, but
maybe we should go back eating them.
Yes.
But it is typically about technology. So it is interesting. And so the fact that it's AI now is no great surprise. If it is, as people suggest, the next real quantum leap in tech's driver of the economy, then look, this sort of thing is inevitable. Of course, you'd want to be across the next big thing.
Yeah.
And to some extent, the sort of capital that flows into this territory is what's needed in that regard. So if you really want to speed up the degree to which a new technology is adopted and rolled out, then this is what happens. There is an interesting aspect, again, not to go back for the 100th time to the .com, but what happened around that big internet boom in the late 90s was that even though the leading stocks or even some of the frothier stocks got hammered and the NASDAQ as a whole collapsed, and it was a big 3-year bear market, you got to remember that. And I don't think the NASDAQ recovered its peaks for at least 10 years afterwards. So the broader aspect of tech at the time as the real technology was that at the time an infrastructure had been rolled out around the world. So a fiber optic cable was the real big infrastructure kind of transformative thing at the time. And even though lots of these stocks went by the wayside and lots of these companies went by the wayside, the infrastructure was left. And what it did was it cheapened the access to that. And so the technology continues to expand, continues to be used, continues to develop at much cheaper rates than there would have been at the peak.
Yep.
So if there are good aspects of them, there can be. It can accelerate the technology, but it can be very damaging to anyone involved. And of course, that's we're talking about equity bubbles. I think with credit bubbles, it's a very different story. It's hard to see anything positive
from a credit bubble.
Credit bubbles, or at least credit busts, because when credit busts happen, it can take an awful long time to repair.
I suppose it's perhaps the legacy, the bubble's legacy can be good, even if it can be very painful along the way.
Yeah, it can be a way to accelerate the investment in that area. But like everything else, if you knew what the winners and losers were at the beginning, then we'd all be rich.
Listen, we wouldn't be sitting here talking on this podcast, Mike, right? We'd be we'd be on our yacht.
Yes, indeed. Yes, indeed.
A big thank you to Mike for his time and insights. You can catch his work on Reuters.com and the Reuters app. Now for the quiz. We asked you which .com company was one of the biggest flops of the early 2000s. Was it A, Boo.com, B, Webvan, or C, Pets.com? And the correct answer is B, Webvan. Webvan was one of the most ambitious .com startups, aiming to revolutionize grocery delivery. But despite raising hundreds of millions of dollars, it burned through the cash and filed for bankruptcy in 2001, becoming a cautionary tale of the era. This is Reuters Econ World. Every week, we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. Sound design, music composition and engineering on this episode was by Josh Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Wall-Jasper, Jonah Green, David Spencer, Abasoy Adelusi, and Sharon Reich-Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.